Stock markets continue to reach new all-time highs in the U.S. Goldman Sachs recently updated their S&P 500 outlook to 6,300 points by year-end Q1 2025. Now, Middle East tensions remain top of mind for investors. Could things escalate between Israel and Iran? And if so, how would the markets react to that information? Long term, though, what are the fundamental drivers of equities performance? We're here to discuss this theme with Darius Dale. He is the founder of 42 Macro. He's going to give us the medium term and long term outlook for the markets and how investors should be positioned right now. Darius, it's the first time on the show. Pleasure to host you today. Welcome.
It's a pleasure to be here, man. Thanks for having me. I just want to say congrats, man. I've been watching your growth from afar. It's been awesome to watch, man. Yeah, so congrats on everything you're building.
Oh, well, thank you. And congrats on the company. You told me offline you started this company not too long ago. And I've been seeing your research, tremendous research. Let's start with recent news first. And I know that your research is based on more longer term fundamentals, but we can't ignore, I guess, some short-term news items that may or may not, and I'll let you answer this, may or may not increase volatility. What's top of mind for you right now in terms of risk factors that could derail the 6,000 S&P target that a lot of people have been giving me on my show?
Yeah, look, I mean, I think it starts, so phenomenal question. I think anytime you think about trying to understand what the full balance and distribution risks are when you're approaching asset markets, I think it's important to understand what has caused the current positioning to build. In our view, the current positioning is associated with a function of three themes. One, our resilient U.S. economy theme, which we authored back in September of 2022. We've seen a general and persistent upside surprise in U.S. growth, which we've been calling for the past couple of years. We expect that to continue. And that, in our opinion, has contributed to some of the mildly crowded positioning that we've seen on the long side of risk assets. The number two theme that we're highlighting is the here comes the liquidity theme. We have the view that both U.S. and global liquidity are set up to accelerate markedly over the medium term. And that's partially a function of the number three theme, which we've maintained since November of last year, which is our J want the soft landing theme. This is a Federal Reserve that has an asymmetrically dovish reaction function. And anytime you hear the phrase asymmetrically dovish reaction function, it generally pays to be bullish as an investor.
Well, let's just highlight some of your high conviction calls. So this came in from a recent research summary that your team sent me. High conviction, again, like you just mentioned, the liquidity issue. A weak USD should accelerate global dollar recycling and provide Chinese authorities scope to accelerate support of their economy. Does this narrative or this thesis depend on who is president by January, Darius? Because we do know that Donald Trump is very much bullish on the dollar. He wants a strong dollar. He's adverse to the dollar losing its reserve status. Vice President Harris has not made similar comments. So I'm curious to see how her monetary policy or even fiscal policies would translate to the dollar. But what is your take on whether or not the election may impact the dollar?
Yeah, the election may certainly impact the dollar. If you think about the two choices that we have as candidates, we have Kamala Harris and Donald Trump. With respect to, I think the markets are assuming that there's going to be a significant change in tariff policy and how the U.S. is, sort of responding to Chinese trade policy. And the reality is there's not much of a difference. Well, the big difference that we see is that we're probably going to see an incremental application of tariffs towards China, but it's very unlikely, just based on the folks that Trump has surrounded himself with respect to his economics team. If he were to win the election, it's very unlikely that we see anything in line with what he's been sort of talking about on the campaign trail. It's very typical of what you see in elections, which is politicians promise a lot and deliver a little, and that's sort of our expectation. But it could be something that could cause our conviction in that theme to wane in the coming months.
Okay, so let's highlight some of the negatives from both campaigns, at least the worries from investors. On the Trump side, tariffs. So people are concerned about tariffs. Trump has promised to slap on 100% tariffs on some Chinese EVs, for example, where actually, no, not 100%. He recently said 200%. He raised that to 200%. He promised to increase tariffs to 100% on those countries that want to ditch the dollar, trading with the dollar. Let's comment on that first before we move on to the Harris side. Donald Trump's tariff policies, are they bad for the markets? In the past presidency, we saw that markets did not like new tariffs on China. Would things be any different now?
We have a different take on that. I mean, we don't think this stuff matters all that much to markets at all. I mean, if you think about what really genuinely matters to asset markets over medium to long-term time horizons, it's usually one of the these four things. It's growth, it's inflation, it's policy, and it's liquidity. Every now and again, the profit cycle will kind of rear its beautiful or ugly head, depending on where you are in the business cycle, to have a significant influence over asset markets. But in our view, the things that you need to pay most attention to as investors are growth, inflation, policy, and liquidity. And with respect to growth, inflation, policy, and liquidity, three of those four cycles, as we talked about at the beginning of the show, are moving in a direction that is supportive of asset markets. The inflation cycle is unlikely to continue moving in a direction that's supportive, if only because, not if only, but tariffs would obviously be a secondary headwind with respect to that cycle. But if you go back to 2019, and I'm pulling this off the top of my head, so don't quote me on this, but I want to say markets rallied about, the S&P 500 rallied about 35% in 2019 at the height of the previous Sino-U.S. trade war that was obviously engineered by executive policy in the Trump administration. So we're not of the view that that's going to be the only thing that matters to asset markets. In our opinion, those bigger cycles are what's really driving the boat here, and we have a moderately sanguine view on most of them.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below, or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. And by the way, JD Vance made this point during the VP debate. He said that tariffs have not been inflationary during Trump's presidency the last time. Take a look at the CPI chart. Let's just fact check this, if you will. Have tariffs been inflationary? The CPI overall, and we can segregate this by specific items, but overall, during Trump's presidency, the CPI didn't spike to abnormal levels until we had the pandemic, and then the Fed introduced unlimited QE. But can you make the argument? Now, let me just make the argument that tariffs have not been inflationary overall in the last administration, just looking at the data. Am I wrong, Darius?
No, you're correct. Tariffs are a regressive tax on consumer spending. So it's very likely to be durably inflationary. You could have a one-off change in the price level that creates a one-off shock in inflation. And I do believe we saw that in 2018 relative to the trend of inflation that we observed in the post-crisis era, post-GFC era. We did have a significant increase in inflation to right around 3% on a core basis in 2018. That was a big change from what we had experienced for the prior 5 to 7 years. So that was a meaningful shift. However, it wasn't necessarily inflationary in the way that you, I, or consumers across America are currently sort of characterizing that today. So again, we don't believe that tariff policy in and of itself is inflationary. What we see the biggest upside risk to inflation stemming out of either the Trump or Kamala Harris administrations, because we have a relatively sort of similar view on the outlook for fiscal policy in either administration. Where we see the inflation, the next round of inflation to come from is populism. And we continue to see populism brew up on both sides of the aisle, mostly as a function of the broken down social contract that we have here in America. I'll show a chart from our most recent macro scouting report. Every month we publish this report for our clients here at 42 Macro, where we try to help them, kind of hone in on all the, kind of big growth, inflation, policy, and liquidity drivers of asset markets, and so provide them with a very sanguine, clear view of how those things are likely to unfold. And when you look at this chart here, we show employee compensation divided by nominal gross domestic income. That's declined to about 56%. We see corporate profits as a share of gross domestic income that has accelerated to 13%. If you go back and you look at the long-term means of these time series, the respective means of these time series, they were 63% and 9% respectively. So we've had essentially a 400 basis point shift away from employee compensation into the corporate profits. Now, that doesn't sound like a lot, but it's a significant deal as it relates to what drove that shift. we've seen a hollowing out of the U.S. manufacturing sector over the past 20 to 35, 20 to 25 years. And as a function of that, we've seen a greater and greater share of corporate profits go to, or a greater and greater share of national income go to corporate profits. And part of this, in our opinion, was globalization. Obviously, we had the NAFTA agreement in the late 90s. We had China join the WTO in 2001. And as a function of those policies and other policies, not the least of which was QE, incessant QE, sort of siphoning, creating a stimulus for the incomes of the folks in the upper income of the distribution. We've had a series of policies in this economy that have really kind of put the middle to lower, quote unquote, class on its back, middle to low income household consumers on their back. And as a function of that, they're pissed off, for lack of a better word, David. They're upset. They're frustrated. And they're looking for solutions. This is why Donald Trump is a politician. This is why we've gotten a sequence of populist monetary and fiscal policy since 2008. And we are likely to continue to get a sequence of that populist fiscal policy going forward.
Sorry, what is a populist monetary policy?
Populist monetary policies is socialist monetary policy, the policy that won't allow big banks to fail. The policy that won't allow, hedge fund managers, my clients, to actually have bad years. That's the kind of policy that we see. It's really just all a function of what we see as kind of the main driver of this, which is, we have this socialist economy that's sort of masquerading as capitalism. But the reality is when you have socialism, Democrats, they practice socialism for the poor. If you look at the government social benefits divided by household income, that's been up and to the right for the last couple of generations. If you look at the effective corporate tax rate in this country, that's been down and to the right over the past couple of generations. So both parties are combining to support the incomes of their quote unquote constituents. But the reality is Donald Trump, based on some of the work that my former colleague and mentor, whom you recently had in your show, David Neil Howe, based on some of the work that he's been exposed to vis-a-vis Steve Bannon, he understands this chart here, slide 99, which shows the breakdown in the social contract here in America. And as a function of that, he's caused not only just the Republican Party, but he's also pulled the Democrat Party even more left and even more populist.
By the way, on taxes, okay, so Kamala Harris wants to raise the the capital gains tax, not corporate tax. She wants to raise corporate taxes as well, but capital gains tax to 28%. That would effectively bring a combined total capital gains tax for the top earners to 33%, which would be the highest since 1978. Would that cause a market sell-off?
It probably would, yeah, but it's unlikely to occur, right? I mean, you have to essentially have a supermajority in the Senate in order to get that done. So it's very likely that no matter who wins the White House, we're probably going to have some form of a divided government. The highest probability outcome, we don't. The top of the ticket is a toss-up, but we know that the Senate is more than likely to flip to a Republican leadership, and we know that the House is a reasonably high probability of flipping mildly into Democrat leadership. So right there alone tells you you're probably not going to get some of the more left, more aggressive policies from either candidate. And so what's more than likely to occur, which is why we continue to believe that populism is the only outcome from the starting point, is what's more than likely to occur is both parties are going to have to come together to figure out the deals, what they want out of the negotiation of the expiring core tenets of the Tax Cuts and Jobs Act. Recall that at the end of next year, we're going to see significant changes with individual tax policy going back, essentially reverting back to where they were in 2017 prior to the Trump tax cuts. And so we know that no matter who's in office, neither party wants that outcome to occur. You don't want to implement a significant tax hike on a consumer, particularly in an economy where we're already observing evidence of slack being created in the labor market, inverted yield curve, et cetera, with the Fed, kind of responding to all those things. You don't want to hike a bunch of taxes because you're essentially going to cause a recession. So what's more than likely to happen, David, is Republicans get what they want on their wish list. They'll probably get 80% of their wish list, and Democrats will get 80% of their wish list, no matter who takes the top of the ticket. And in our opinion, we want investors to be focused on that as the underlying message from U.S. fiscal policy is that the entire curve is shifting left or shifting populist, both parties included.
By the way, the increase in the capital gains tax that I just read to you applies to only those people making more than $1 million annually. So, the top 1% of the population. The argument here from the conservatives is that, well, those people are the people driving growth in the economy and consumption on the most part. What is your philosophy here? Does wealth trickle down? In other words, if you derail the wealth effect for the wealthiest, will that derail the entire economy?
Yeah, it more than likely would. I mean, I'm not a big fan of the K-shaped U.S. economy. As someone who grew up on the very bottom and part of the K, spent half of my life on the very bottom of the K, and now I guess I'm on part of the top part of the K now. Lord willing. But in our opinion, yes. So the answer to your question, David, is yes. So if you look at the share of income, consumer spending by income cohort here in America, what we see is that the upper third of households by income account for 51% of consumer spending, which compares to only 15% for the lower third. So, one of the things that we've been, sort of pounding the table on for the past couple of years that has become consensus, but it wasn't consensus when we authored the theme back in September of 2022, was our resilient U.S. economy theme. And part of the one of the core tenets of that theme was what you and I are discussing right now, which is the environment for rich people in this country is actually quite favorable. We have policy that is getting incrementally favorable, and as long as that's the case, and as long as asset markets, back then we were kind of at the lows of markets, but if they started to recover, which we anticipated that they would, if they started to recover, then you're going to see a continued expansion of the U.S. business cycle, and that's exactly what we've observed, and that's exactly what we're likely to see, assuming that no policies are going to be no significant policies are going to be enacted that kind of disrupts that apple cart. And again, it's very unlikely we see the apple cart materially disrupted in the context of the composition of the White House, the composition of the White House and Congress that we're going to observe, some point in Q4. I mean, again, we don't have the view that the election is going to be decided on November 7th, but we do have a view that we're probably going to wind up with divided government. And divided government means both parties get what they want, as opposed to neither party gets what they want. It's game theory.
Okay. That's very interesting. So what you're saying is, either way, can we see the wealth gap close or not widen as much if the country is leaning more socialist from both parties?
Well, that's one of the key core tenets of the fourth turning, right? I mean, you think about one of the big dynamics that occurs in a fourth turning is you typically have a significant decline in income inequality. That's something that we've observed. So we did a big deep dive statistical study, piggybacking on my Milhouse's work on the fourth turning. His work is more focused on the geopolitical drivers and outcomes in the economy. We're focused more on what's going to happen with the economy, what's going to happen with policy, and how all those things are going to impact asset markets. Because again, what we're trying to do here at 42 Macro is help our clients make money in financial markets. And so one of the things that we typically observe in a fourth turning in the context of this big deep dive empirical study that we did, where we analyzed time series going all the way back to 1800s, so we can get a sense of how do these time series statistically evolved in this fourth turning process. And one of the things we found, with data as far back as we can get it, is that if you go back and you look at income inequality as a function of the top 10 share of national income, what you typically observe in this previous fourth turning was that it declined sharply throughout the duration of the fourth turning. And so we're kind of, we're starting from a very high level again, and it's our expectation that income inequality declines sharply throughout the duration of this fourth turning. So we're going to see policy, in our opinion, that is incrementally populist, that essentially it's, Robin Hood policy, if you will. We're going to take from the rich and give to the poor. Now, it may not happen next year in the context of a divided government. It may be in response to a bigger crisis that investors are, sorry, that both households and investors need to navigate. But ultimately, I think as someone as an investor, or just even someone as a voter, you need to be aware that things are probably going to get better after they get worse in the context of this broad fourth turning view.
I interviewed Neil Howe on the fourth turning, and one of the tenets of the fourth turning, but by the way, for the viewers who don't know or are familiar with the concept, every 80 years, there is some sort of generational crisis that needs to happen. And you probably know more about this than I do, so you can explain more detail. In this fourth turning, a lot of things could happen. Rise of populism, like you talked about, rise of conflicts internally and perhaps even externally. So we're talking about civil conflict, civil war, perhaps in the extreme case, and obviously global wars as well rising. We're talking about perhaps a different change in attitude from one generation to another. But generally speaking, from what I gather from Neil Howe, we're looking at perhaps more volatility as more fear ratchets up. But yet you told me offline, and this is your core thesis for investing, is that you're still medium-term bullish. So how do you reconcile the differences between the coming of the fourth turning and your bullish outlook?
Yeah, 100%. It's how the fourth turn. It's how policymakers have historically responded to these geopolitical and economic, socioeconomic developments. Historically, they've responded with two things. One, a lot of fiscal support of the economy, which obviously creates a higher nominal GDP environment, which is generally supportive for asset markets or for risk asset markets, less so for defensive assets like treasury bonds. And then what we typically see from the Federal Reserve is monetary debasement and financial repression. And so it's our belief that as a function of those three things, excessive fiscal policy, support of the economy, monetary debasement to capitalize that fiscal support, and currency devaluation to capitalize that fiscal support as well. If you put those three things together, you should be, just like we've been for a long time here, 42 Macro, structurally bullish on risk assets like stocks, credit, crypto, commodities, and structurally bearish on defensive assets like treasury bonds and the US dollar. Doesn't necessarily mean the treasury bonds or the US dollar are going to decline in price. The dollar will likely decline in price as a function of those policies. But doesn't necessarily mean the treasury bonds are going to decline in price because we're getting financial repression. So, I'll show you a couple of charts from our fourth turning analysis that sort of support that takeaway. So one of the things that we observed in this study that money supply growth tends to accelerate sharply during fourth turning. So that's something that we're anticipating as investors. If we have a significant uptick in money supply growth, you're talking about a significant uptick in liquidity, and historically, a significant upticks in liquidity have done, that have perpetuated, raging bull markets in risk assets. The other thing I would highlight is with respect to the financial repression that we're likely to see. The 12-month real T-bill yield has tended to decline substantially in fourth turnings, which means the Fed has a negative policy rate on an inflation-adjusted basis. You've also seen the similar dynamics with the 10-year real Treasury yield. So there is an evidence of financial repression occurring in this fourth turning, and we have a belief that we're probably going to see even more financial repression in this particular fourth turning than we have historically. If you look at this chart here, where we show the private sector, we break down the marketable Treasury securities market into its various large investor cohorts. So you have the Federal Reserve, which is shares declining. It's plus 16% or 16% of the total now. You have commercial banks, U.S. commercial banks. Their share has been declining since 2021 as well. They're now 15% of the total. And then if you have foreign central banks, which is a black line, that peaked back in 2008, their share continues to decline at 14% of the total. So if these three major cohorts of investors are all sort of divesting at the margins, relative or the very minimum, not keeping up pace with the growth of public debts here in this economy, that means the private sector has to pick up the slack. So the private sector was 36% of the marketable treasury market back in late 2021 when we called for bond yields to materially accelerate to the upside as a function of the return of the Treasury's net financing policy in 2022. So that's obviously something that we were accurate and prescient on. But when you go look at that 36% ratio, it's now up at 54%. So the private sector investors now, real money investors now own 54% of the marketable treasury market, up from 36% just a couple of years ago. And just the reason that's important, David, is because investors will demand higher yields to capitalize Uncle Sam. We, the private sector, want return for the units of risk that we're taking in our portfolios. We're not just going to, buy a treasury bond at any price like a foreign central bank would or a commercial bank would based on, changes in regulation, Basel, Dodd-Frank, et cetera, or the Federal Reserve would if they're implementing a large-scale asset purchase program. And so that's, in our view, the Fed has to do something to offset that. And so we're going to see more currency debasement. We're going to see more financial oppression by banks into the treasury market. Currently, banks are 18% of their total assets are in Treasury and agency securities. When you do some ratio math, because we don't have that time series going back as far, you can do some ratio math. It was about 47% of commercial banks, Treasury and agency securities back in the prior fourth turning. So we know that numbers are going up. We know the Fed's balance sheet's going to go up. And we also know that foreign central banks, depending on how this geopolitical developments progress throughout this fourth turning, are probably not going to increase their share. So as a function of all that, then the Fed and regulation that financially represses investors into the Treasury market will have to accelerate markedly. And all those things are incredibly bullish for risk assets.
Okay. And your base case and your base case assumption here, flipping back to my screen on your notes here, your base case assumption is that the U.S. economy will remain resilient, medium conviction rather. The U.S. economy remains resilient due to historically strong sector balance sheets. You just talked about that. To what extent would the war in the Middle East derail this thesis here?
Yeah, I mean, look, I'll say this, and I don't mince words about this. Obviously, we have a tragic situation, what's going on across the middle, across the world, all over the world. Obviously, Russia, Ukraine, we all seem to forget about that one as well. What I've noticed throughout my career, and my career began on global Wall Street at the depths of the financial crisis in 2009, we've seen nothing but geopolitical consternation, whether it be outright wars, deaths in wars, conflicts, the total amount of conflicts, the headlines associated with conflicts. Those statistics have done nothing but go up and to the right throughout my entire career. You know what else has gone up and to the right throughout my entire career? The stock market, Bitcoin, gold. So in my opinion, a lot of you got to focus on, in my opinion, this is our humble opinion, and it's using my humble opinions to help thousands of investors around the world make tons of money. You got to focus on the things that actually matter most to markets. And so, David, to your point, the way we would characterize the impact of an acceleration in the conflicts that we're seeing with Israel and Iran, which, by the way, that conflict began a little bit over a year ago. Stock market's up 35%, Bitcoin's up like 150%, gold's up like 30%. Again, it's not the conflict that matters. It's how policymakers respond to the conflict and or not even pay attention to the conflict at all. So in our opinion, how that will ultimately derail asset markets is through the lens of liquidity. So one of the things that we do in the context of our longer term views, we obviously have to keep an eye on the cycles. We have to risk manage the cycles. So if you think about this just from thinking about this from a secular standpoint, we think the line is up and to the right with respect to risk assets. However, that does not mean we don't need to risk manage cycles along the way. There are plenty of cycles to risk manage along the way. And if you're, too long at the top of the cycle or not long enough at the bottom of these cycles, then the total amount of return, the total return you're going to face in these cycles, and both on a Sharpe ratio basis and also on a nominal basis, is going to be much lower than investors who are respecting those fluctuations. And so we have to do a lot of research around where we are in the growth cycle, the inflation cycle, the liquidity cycle, the policy cycles to understand, okay, where are we? Are we here? Are we here in the context of this longer term structural bullish bias? And so one of the things that we do to help investors understand that is we do a lot of work on liquidity, what's happening with respect to the liquidity cycle. And so, when we talk about liquidity, it's important for investors to know that if you don't have an informed view on liquidity, it's probably a big detriment to your investing activity. And how we define liquidity here at 42 Macro is the aggregated sum of the world's major central bank balance sheets, the broad money supply from those economies, their FX reserves minus gold from those central banks, and then we run a bond market volatility overlay to account for fluctuations in the repo market, which also have an impact on the overall risk taking that we see in financial markets. And since the global financial crisis, since 2007, risk assets have only corrected or crashed for two reasons: either the declining liquidity or a refinancing air pocket, which means that there wasn't enough liquidity for the previous issued debt around the world to get refinanced at appropriate rates. And so you had a drawdown in total non-financial sector debt. So if you look at the black dotted lines so in this chart, we show our global liquidity proxy. That's the blue line. S&P 500 is the red line. The total non-financial sector debt is the shaded area. And the black dotted lines coincide with the big corrections and crashes that we've experienced as investors since the start of 2007. And every single one of them, with the exception of Armageddon, coincided with a refinancing air pocket or a decline in global liquidity, or both. And so it's our view that if you're going to have the Middle East sort of the consternation that we're currently seeing in the Middle East, if that deteriorates to an all-out war between Israel and Iran, that won't be the issue. What will be the issue is that we're going to have a refinancing air pocket and a decline in liquidity. And so currently, if you look at our forecasting tools, we understand what the key leading indicators of liquidity are with respect to a 3 and 6 month lead. It's stocks, it's crypto, it's the US dollar, it's FX volatility, it's interest rates, it's bond market volatility, it's growth, inflation, unemployment. And so we, at all times here at 42 Macro for our clients, we're maintaining this model and refreshing this model to help them understand where is liquidity likely headed over the medium term. And we do this by taking the sum of the correlation adjusted z-scores of those variables and subtracting the current z-score of where our liquidity proxy is. And if there's a positive residual or significantly positive residual, then we'll have a view that liquidity is likely to increase significantly over the medium term, or vice versa. And right now, we are in the view that liquidity is going to continue to trend higher over the medium term. Right now, if you look at all the major economies in the world, the global liquidity is trending higher, Australian liquidity is trending higher, Canadian liquidity is trending higher, Canada or Chinese liquidity is trending higher, and it's going to accelerate meaningfully in the coming months. Eurozone liquidity is trending higher, India's liquidity is trending higher, Japan's liquidity is trending higher, Swiss liquidity and UK liquidity is trending higher. The only countries where liquidity is not currently trending higher is the US and Brazil. And so if you put this snapshot together with what's already currently happening, then you can kind of wind up in a place where The only way this could derail things is if we actually have significant pullback on some of those drivers of liquidity, like the dollar gets stronger, fixed income volatility accelerates, and so you have to have a more informed view on what could potentially cause that.
How are you measuring liquidity? Is it bank lending, money movements, capital flows?
Great. Yeah. So it's a little bit of all those three things. So we'll take a step back. We think liquidity comes from different sectors of the economy. It's not just all coming from central banks. It's not all coming from the private sector, commercial banks. It's not all
Yeah.
coming from the repo market. It comes from all three actors. So how we measure liquidity in the context of our 42 macro net, the global liquidity proxy, which again is the blue line in this chart here. That is the aggregated sum of all those central bank balance sheets that we just walked through. It's the aggregated share of their, or aggregated sum of their broad money supply, which we walk through, and it's the aggregated FX reserves minus gold, because obviously a lot of those FX reserves get recycled into liquidity instruments, and they reduce the burden of net financing for private sector investors, which allows them that frees up capital for them to go invest elsewhere. And so, one of the things that I think could potentially cause an issue in the context of our sanguine medium-term outlook for asset markets through the lens of the Israel-Iran conflict or any other many conflicts that are currently going on that none of us are talking about right now, because quite frankly, they don't really matter to asset markets. And again, this is a program to help investors figure out where asset markets are headed. Those things, if you think about what could potentially cause that, is how will this impact the US dollar? How will this impact US rates? Because those are the shortest, those are the most reactive things that would cause an inflection, a significant inflection on liquidity, starting with the dollar here. If you get the dollar right, you're probably going to get the general direction and trend of liquidity right. I.e., if you're right on the medium-term outlook for the US dollar, you're probably going to get the medium-term outlook for US liquidity right, or for global liquidity right. That's not always the case, but it's generally the case. And the reason for that is the dollar is a significant influence over global financing activity. Dollar is 60% of FX reserves. It's 60% of cross-border bank lending. It's 70% of international debt securities market. It's 79% of trade invoices. It's an 88% of foreign exchange transactions and 99% of stablecoin backing. And so, how a weak dollar would. So how? Let's assume your sort of your question is kind of leading us to the same place, which is, let's assume that we did have a significant pullback in asset markets as a function of the Israel-Iran conflict. How would that actually, what would be the mechanism for that to occur? It would obviously result in investors thinking that there's more inflation in the system, therefore pricing out the scope of rate cuts that are currently priced in US dollar money markets. That would strengthen the dollar and cause the supply and demand for global cross-border financing to decline. But the supply goes down because the borrowers, their creditworthiness declines because their currencies are declining against the dollar. The demand goes down because the currencies are declining, and it's a little harder to service the debt. So that takes out one pocket of liquidity from the private sector. Then obviously you have foreign central banks probably unable to price in as many rate cuts into their forward rate curves, with forward guidance into their forward rate curves. That obviously causes that to unwind as well. And then you probably have a decline in global trade as a function of businesses and consumers getting incrementally concerned about the outlook for the global economy. And so you sort of have a inverse of what we're calling for. We're calling for all those things to be moving in the positive direction, as they have been for the past year plus. But we ultimately see that there is a risk, to your point, David, that those things stop. But we're not forecasting them to stop. We're not going to, kind of base our investment decision making on, what we feel is likely to happen with the Israel-Iran war.
Okay, on the issue of the U.S. liquidity situation declining, that's interesting. I'm gonna let to drill in a little bit deeper on that. Let me just show you this chart first. Unrealized. This is from the FDIC website. Unrealized gains and losses on investment securities. This is share of longer term loans to securities 49.6% of first quarter of 2024, down 51%. Anyway, you can see here held to maturity securities and available for sale securities all underwater. And they have been ever since 2022. In fact, this is in nominal terms, the most amount of unrealized gains or losses rather ever. Far worse in 2008. I don't know if this is significant at all, but just by looking at this, I'm assuming, or I'm guessing, that banks are more unwilling to lend if a larger amount of the securities held for maturity are not doing well.
Yeah, no, to me, this is the most bullish chart of macro.
Really?
Yeah, oh yeah, absolutely. Because what it means is that the policymakers, it stopped the policymakers dead in their tracks back in 2023. I mean, that's what it did. I mean, you go back to the UK gilt crisis in the
Mm.
fall of 2022, where essentially we had a significant VAR shock in the UK gilt market that caused the Bank of England to completely reverse course in their policy. The VAR shock that we had across commercial banks and in the regional banking crisis last year essentially caused the Fed to reverse course on its policy with its forward guidance. Obviously, they got one more rate hike done from there, but the markets had already inflected. If you look at the slope of the U.S. money market curves from that point, and so this is, in our opinion, it's how the policymakers deal with these problems that creates the outcomes in asset markets. And obviously, with respect to the Fed, we got the BTFP, we got the dovish forward guidance, we got Jay now pivoting from I want to see pain to I want to see a soft landing. This was all in part and parcel in response to this issue. Because at the end of the day, what we're observing around the world is very clear and cogent evidence of central bankers prioritizing financial stability over economic outcomes, particularly over their price stability mandates. And as long as that's the case, you cannot sit there and be in defensive assets that are going to get eroded away by inflation. There's likely to be a sustained fund flow dynamic in support of risk assets and gold, Bitcoin, gold, stocks, all those types of assets that are not nominal and not tethered down to the U.S. Treasury market or global bond markets. And in our opinion, this is bullish because the policymakers are responding with dovish policy.
Okay. So let's turn over now to the China stimulus story. Just
Okay.
today, actually, on Tuesday, it was announced that the government officials met, I think, the night before, and they disappointed Chinese investors with I think, a lack of additional stimulus. Yeah,
Before we go to China, there's one more thing I want to point out
sure. Yeah, please.
in the context of this conversation we were just having.
Yeah.
If you look at U.S. liquidity, so we were talking about global liquidity prior. Global liquidity is currently trending higher, and we're expected to continue trending higher. Obviously, if we get some news that could cause an inflection in that, then we'll have to respond in a Bayesian manner, which is why I do my job 6 days a week. But anyway, getting into U.S. liquidity. So how we track U.S. liquidity, which is basically how the world tracks it now. We actually invented the whole concept of net liquidity, which is the Fed balance sheet minus the Treasury general account balance minus the reverse repo facility balance. That had been in persistent decline all the way through the end of 2022 and really into the early part of 2023. It's been flat since then, despite the fact that the Fed has continued its quote unquote quantitative tightening program. And the reason it's been flat since then, for two reasons. One, primarily because we've had a significant decline in the RRP. But why have we had a significant decline in the RRP? It's because you go back to the early part of 2023, which is what we talked about in terms of the Fed's reaction to the regional banking crisis. From that point forward, the forward rate curves for the U.S. money markets were negatively sloped, i.e., investors were pricing in rate cuts and rate cuts and rate cuts on a go-forward basis. And so, in our opinion, those rate cuts that were being priced in the forward curve obviously were supportive of the returns that we've seen since then in the bond market. And the inversion in the yield curve. And so the dovish policy, or at least investors expecting dovish policy, and ultimately the Fed ratifying that with its actual words and actual policy, have been one of the key reasons why U.S. liquidity has stabilized despite the Fed's quantitative tightening program. And ultimately, when you get into the first quarter of next year, as a function of the debt ceiling negotiation process, the debt ceiling moratorium lapses on January 1st, as a function of what's likely to be a relatively lengthy debt ceiling negotiation process, if we're right on our call for divided government, then you're probably going to have a significant drawdown in the Treasury general account balance as well, which is also supportive of the liquidity, supportive of U.S. liquidity, the same way that the significant decline in the RRP balance was as well. So again, this is sort of the environment, the economic environment. It does not necessarily mean to scream bullish. It's the policymakers' response to the economic environment that we need to be most abreast of as investors, and why we continue to be relatively sanguine on the medium-term outlook for asset markets. Sorry, I didn't mean to cut
Okay,
you off.
so then let's actually sum up your outlook on U.S. markets. So you're bullish on what exactly? Stocks, bonds, all of the above?
Yeah, no, definitely not bonds. I mean,
Okay.
we made the call going back to September 17th to get out of the long bond as a function of our medium-term views on the economy and how policymakers are going to perpetuate that with incrementally dovish policy.
Yeah.
Right now the Fed is cutting interest rates into a late cycle expansion that does not need policy support. And so what it's likely to do is cause both growth to continue surprising to the upside, which is are currently already baked into our forecast, and it's likely to cause inflation to start to grind higher over the medium term. So in our opinion, that's very negative. That's a higher than expected nominal GDP environment, which is what we're calling for on a next 12-month forecast horizon basis. That, in our opinion, is very unlikely to be supportive for bonds. However, it is likely to be supportive for stocks and other risk assets, particularly in the backdrop of U.S. and global liquidity accelerating potentially markedly in the first quarter of next year.
We do know that the Fed funds rate is going to come down either way. What is the relationship between the short end of the curve and the long end?
Yeah, well, I mean, in our opinion, there's not a tremendous linkage from our perspective. What we've seen throughout this business cycle is we've seen massive fluctuations in what was priced into from a forward rate curve perspective, both to the upside and to the downside. But what's really driving the boat, in our opinion, is what we see here on slide 37. Ever since we authored our U.S. resilient economy theme back in the fall of 2022, real economic growth has generally and persistently surprised consensus expectations to the upside. When you look at our forecast, we're expecting that dynamic to continue. And so ultimately, we don't think what matters. We think the Fed should continue to front load policy rate easing because they will increase the probability that Jay gets the soft landing that he wants. And ultimately, we think that is what he wants his legacy to be as an investor. But as an investor, that doesn't necessarily mean you need to be long bonds. What we're essentially saying is the economy's fine. The labor market's fine. You don't need to run out and buy a bunch of bonds. In fact, investors probably bought way too many bonds going back to when we told them to sell them a month ago.
Okay. Do you have a target for the S&P 500 for us?
No, we're institutional investors. We don't have price targets.
Okay.
For us, it's about whatever return we get throughout the duration of the market move is the return we get. We're not going to tell the market what it has to do for us.
I only have one question on China, and where I was going with China is that the stimulus package that was announced, it was immediately bullish for commodities, particularly base metals. Now, if base metals continue to rally on the back of more stimulus, by the way, they fell today because the stimulus measures announced last night failed to meet investor expectations. So the CSI in China and the Hang Seng fell. The Hang Seng had its worst day since 2008 today. Very, very fickle market over in China. But anyway, my point is, if the base metals do continue to rally, that could, in theory, feed into inflation as that is an input cost for a lot of things, including construction. Does that transmission mechanism make sense to you? China's stimulus bullish for inflation across the board, not just for China?
Yes, but we've had a view on inflation that inflation is unlikely to return durably to trend absent a recession since January of 2022. So what China's doing is only supportive of that view. Go back to that fundamental research summary that you put up at the beginning. So that's our oldest research theme that we've been operating here as investors in 42 Macro. And the core tenet of the theme is that when you go back and you study business cycles here in the U.S. economy, what we find is that two things. One, inflation is the most lagging indicator of business cycle. It typically doesn't break down durably below trend, until the recession. And number two, there is no historical evidence of it breaking down durably below trend prior to recession. So on a median basis, it doesn't do that. And then if you go back and you look at every observation in the sample and every post-war business cycle that we've had in the U.S. economy, we've never seen inflation. We've never seen the Fed win on inflation without a recession. And so it's our view that the Fed has a choice to make. And we would argue that the Fed has already made the choice. The Fed has made the choice that it wants financial stability. It wants a smooth functioning in the treasury market, which obviously the regional banking crisis was the shot across the bow to tell them that they need to do something different. They want smooth function in the treasury market. And that is more important, unfortunately, for the folks like myself, who, like I used to be on the bottom part of the K, the folks on the bottom part of the K. Unfortunately, that means we're going to have to deal with higher inflation. And this is something that Neil talked about in your conversation, David, with you about how historically, how have we financed, how have we capitalized, how has governments capitalized the big changes in fiscal policy that typically occur in the fourth turning? They do it one of three ways: currency debasement, borrowing, and taxes. Well, currency debasement and the borrowing, the Fed has kind of 1.5 kind of units in that. The fiscal policy is obviously the fiscal authority, and we continue to see populist fiscal policy that will be accelerated in the coming decade. But the Fed's responsibility in that is to make sure that we are comfortable buying a treasury bond with a real interest rate that is negative, potentially deeply negative as we progress throughout this fourth term.
Good segue. Final part of our conversation: currency debasement. You told me offline that your theoretical ideal asset allocation model would be 60% stocks, 30% fixed income, 5% cash, and 5% Bitcoin.
Correct.
Let's drill down on the 5% Bitcoin here because we talked about the other assets. How does that 5% Bitcoin allocation fit into your currency debasement thesis?
Yeah, so it's a great question. So it's actually 60-30-10. That's our kind of that is our flagship investment strategy that we use to help retail investors remain on the right side of market risk. We use a separate systematic strategy for our institutional investor clients. But with respect to our KISS portfolio construction process, so that is a 60-30-10 trend following strategy that is designed to essentially materially outperform 60-40 over the long term. And if you think about the average annual return of our KISS process, it's right around 15% with a max drawdown of 12% for CalMAR ratio, average annual return divided by max drawdown of 1.3. If you look at 60-40, the average annual return of 60-40 is all the way down at 10%. With the max drawdown of minus 22%. So the CalMAR ratio there is only 0.4. So I think, KISS is doing its job in terms of keeping clients, in the market, participating in this, monetary debasement regime that began back in 2008. We continue to see evidence of that monetary debasement regime not only accelerating domestically in the context of our J1 to soft landing theme, the Fed, by the way, cut the policy rate 50 basis points with core inflation 70 basis points above target last month. So investors, I think we continue to get evidence of that theme. We're trying to do is keep investors invested in the market while also, using our core risk management systems to, kind of help them step aside heading into bear markets so that they can preserve capital and actually have money to invest when we get to the lows of those cycles again. And that's exactly what we're observing right now. So that 5% allocation in Bitcoin is just a function of the bottom up risk management overlay, taking down the exposure to Bitcoin from 10% to 5% directly. And again, this is a trend following strategy. So we're proud of it.
Very, very good. Darius, this was a great talk. So overall constructive on the economy and on risk assets. Any sectors in particular, let's close off here. Any sectors in particular within the S&P 500 that you are the most bullish on?
Yeah, so great question. So we are currently in a Goldilocks market regime. So this is our discretionary risk management overlay table. This is what we use. This is the tool that we use to help institutional investors pick factors long, short, and weight those bets. And so right now we're in a Goldilocks market regime. The key portfolio construction considerations in a Goldilocks market regime, specifically as it relates to equities, are you generally want to be long high beta equities over low beta equities. You want to be long cyclicals over defensives. You want to be long growth over value. You want to be long small and mid caps over large caps. That's generally how you want to be invested as an investor in Goldilocks. So with respect to some of the sectors that we like the most that have broken out most recently that probably have more upside from here are things like energy, things like industrials. On the sector side, it's things like mid caps, small caps, high beta on the factor side, and in global equities, not global equities broadly, emerging market equities, China, EEM, India, those types of equities have historically performed quite well in this context of a Goldilocks market regime. I mean, it doesn't feel like Goldilocks from an economic standpoint, David. But if you think about what's happening in the economy, we have a slowdown in growth that is surprising to the upside. I mean, that kind of sounds like the Three Little Bears story. It's not too hot, it's not too cold. And as a function of that, and the Fed is obviously aiding and abetting that with monetary policy, cutting interest rates, providing dovish forward guidance, they're probably going to slow the pace of fake QT in the coming months as well if they are unable to push through more rate cuts in the first part of next year as a function of the economy proving resilient and inflation starting to firm up again.
Okay, good. Darius, thank you very much for your analysis. Where can we learn more from you? Where can we follow 42 Macro?
Well, I appreciate you, David, man. Thanks again for having me on your show and all the best to you and your viewers. So you can come check us out at 42 Macro. As you can see, we're a very data-driven shop. I cut my teeth on the global institutional flying around the world, meeting with institutional investors, kind of learning a lot of these procedures and processes. And we're really proud of democratizing this for Main Street. This is something that, as I said, I grew up on the bottom part of the K in this economy, and I want to be able to take the blessing of the gift of math that I've been blessed with and actually, create tools and solutions for, Main Street, and in addition to the folks on Wall Street. So we're really grateful for that. That's at 42macro.com.
Okay. Put the link down below, so make sure to follow Darius there. Just curious because you said you basically you told us you grew up poor, now you're not.
Poor would be an understatement, David.
Well, we congratulate you. You're a success story on your own, if that's the case. So
give the glory to God, my friend.
The education system in the U.S., do you think we're lacking, or even in Canada as well, do you think we're lacking financial education in public schools?
Oh, we can go on a rabbit hole on this topic, but absolutely. I mean, I kind of have the tinfoil hat view that they don't want us to know this stuff. At some point, I'll probably fly too close to the sun and wind up missing. But
I'm guessing you didn't learn advanced economics in school, in high school, right? When did you start becoming acquainted with this subject?
I mean, I went to Yale, so I mean, I did start learning that
Okay,
at some
so
point.
at some point, yeah, yeah, okay.
Did start
After
acquiring
high
knowledge at
school,
some
all
point.
right, yeah.
Yeah, but no, I agree with you, David. I do think there's an education crisis in this country, and that's why, in my opinion, I think it's so important for folks like us with platforms to, generate the interest and generate the support for fixing that problem. And it may be one of the problems that we fix in the forward turning, but unfortunately, as our friend Neil would like to say, we probably have to go through the path of perdition before we get to the good part.
Do you feel like, just final question, we'll close off.
Take your time.
Follow 42 macro in the link down below. Do you feel like we are entering the fourth turning right now? Just from your own personal perspective,
I
anecdotes
think
that you've observed in your own life?
Yeah, no, there's a personal perspective. No, I mean, sitting here looking at the forest, miles and miles of forest, so it's beautiful. My life is great. But no, from a purely economic standpoint, from a statistical standpoint, if you go back and like you said with that deep dive empirical study that we done, I mean, there's probably 35 different time series that we've analyzed statistically to help investors understand what's likely to happen with the economy, what's likely to happen with monetary policy, fiscal policy, geopolitics, socioeconomic developments in and for turning. And if you look at how things have progressed since 2008 in this country and really around the world as well, we are sort of tracking right along, trend. And so we have a very high conviction that we are in a forward turning, and B, the forward turning crisis will deepen in the coming years. And as a function of that, we want to make sure investors are participating in asset markets or exposed to asset markets with the appropriate solutions in their portfolio so that they can take care of their families in this what's likely to be an increasingly trying time.
Thanks very much again, Darius. And thank you for watching. Don't forget to like and subscribe and follow Darius in the link down below.